Hello, everyone. Chris Martinson here with Paul Kiker of Kiker Wealth Management. And today we're going to be talking through some things economic. So, hey, Paul, good to see you again.
Hey, Chris, good to see you as well.
Yeah, so I understand you were a little unplugged last week for a bit. That's enviable.
It was great. Went to the beach. We're empty nesters now. Kids came in for half the week, and it was just us for the rest of the week. So it was actually fantastic.
Ooh, how's that empty nester adjustment going? Is it blissful quiet or sort of worrying?
It's part blissful quiet and part terror. Let's put it that way. So
Yeah, yeah,
adjusting to catching up on the chores and sitting around running out of things to talk about real quick. So it's been nice. We've really enjoyed it.
yeah. Oh, that's fantastic. And I know at least was that with all your children?
Yes, yes. So they're
That's
all out.
great.
They're all out.
Yeah. All right. Well, with that, so I just want to well, I got a couple things I want to talk about. So you know me, I like slides.
I like slides too, so I'm glad you've got some, Chris.
All right, well, let me just go there real quick then. So this is the topic I want to talk with you today, Paul. Get your impressions of, is the consumer tapped out? And before we go there, I just want to let everybody know that this video is just for informational purposes only. It should not be considered financial advice. Of course, you always consult with qualified financial professionals, such as Paul, if you decide to work with him. And that Peak Prosperity now has its own registered investment advisory stood up, associated one, and it's called Peak Financial Investing, and that is known as a promoter. And we promote people and companies we really believe in. So we are a promoter for Kiker Wealth Management. And please note that if the promoter receives financial compensation from Kiker Wealth Management, we do that if and only if somebody starts a relationship, and it does not result in higher fees for anybody. And of course, please be aware that investing involves risks. So
Yes.
these are the normal disclaimers I've got to get out of the way to be responsible human in this country I live in. So, hey, this one, pulled this off Bloomberg. Federal Reserve Consumer Credit total net change seasonally adjusted. So consumer credit, look at that. So this is percentage increases. So can you imagine, Paul, that like there are periods of time where the consumer is taking on 40%, increasing its debt by 40% on an adjusted basis. But here we see it starting to roll over pretty hard.
Yes.
And so this is a first sign. I'm thinking that what we're seeing is maybe the consumer's a little tapped out. And I'd love to get your impression on that. And I'm connecting this maybe, or this could be a woke, go broke thing. The foot traffic at Disney down like 40%, which is a huge drop off. Making too much of this, or does this maybe mean something to you?
No, I think it's a sign. There could be some of the woke backlash that's taken place with Disney's drop, but quite frankly, Disney's been impervious to that over the years. I mean, there's been issues with Disney, and it's such a destination that people like to go to that there's this euphoria around it. So I believe that that's an extreme worrisome indicator, a canary in the coal mine of how the consumer is doing right now. That's the first place. The prices have become so expensive. If I remember correctly, what the Star Wars themed hotel closed down correctly.
Yeah. Was it
Closed down, if I'm
$4,000
correct.
a night or something?
Yeah, I think it was 4,500 for 2 night stay at the Star Wars theme, or maybe one night, whatever that number was. It was insane. So, consumers are definitely to the point that they're starting to cut back in various areas. It's going to be a lot slower in housing. That turns a little bit slower. You've got auto market that's turning slower. And of course, all of the flooding and the cars destroyed, that creates demand that's in that market right now. So that may be a little bit slower to turn over. But I'm consistently hearing shopping changes, behavior changes,
Mm-hmm.
inflationary pressures, even though it's down in gasoline and energy for the major part of the indicators of the CPI report that came out today. Food's really wearing on people. And I
Oh
think
yeah.
we've got parts of the society that are still spending like there's no tomorrow. But yes, I think that's a canary in the coal mine, that the consumer is either tapped out or close to tapped out, for sure.
Hmm. Yeah. On the food issue, I know the CPI just came out. I want to talk about that and its relationship to stock prices for a second. I just wrote about that at the site I do these things called daily takes. Today's was about, I call it gooberment, not government. Gooberment lies and the CPI, right? Because
Yeah.
it's just a farce at this point in time. They said, oh, inflation's only up 3%. I'm like, okay, can we talk about my auto insurance? No accidents, just randomly went up 18% this year because reasons, right?
Yeah.
Homeowners insurance, same thing, just some big old random increase. Health insurance, don't get me started on that. There's a
Mhm.
whole rental thing going on for people, even if it's moderating, it went up 20% last year. Who cares
Yeah.
if it only went up a little? I mean, it's just so they're trying to show that, we only have 3% inflation, but if you eat food, and by the way, I'm hard to shock. EB and I, we shop every month or two, we're kind of anyway, we have the python eating a pig approach to things. We just go do it all at once. But even with that, $789 shopping trip, and I carried it in 3 trips.
Oh, oh, that's painful. Yeah, I was
And this
actually,
isn't lobster tails. This is just food.
that wasn't all Wagyu beef.
No, it was not.
It's interesting you said that. So Holly and I were right after we saw the kids off from the beach. We get on the hotel and head up. This gentleman comes in with 2 bags in his hand, and I said, "How are you today?" And the first thing he says $150 right here. That's all he said on the whole ride. 2 bags, that he just carried right up. He was shocked. He said it just keeps getting worse. So
Yeah. Yeah. With somebody just left a comment at the site today. Very, very thoughtful. This woman observed that she's seeing that elderly people are sort of like having conversations in the store and weighing things out and wondering what they can really do. You can just really see that this is causing real hardship. And so, to your point, some people are still spending like there's no tomorrow, right? But my point here is I think what we're seeing in that consumer data is that pain threshold is starting to creep higher and higher, right? And
it
it's
is
never really a problem until it invades your own household, right? But I think more households is how I'm interpreting this.
correct. It is. So, and the interesting thing is there's so much narrative that's built around, you can see it coming in the market. At least this year has been building off of this narrative. Things aren't as bad as we thought they were going to be this time of year. The economy's holding up a little bit better. Corporate earnings are
Mhm.
holding up a little bit better, at least relative to history. And so that's caused this fear of missing out. And we're in the part of the cycle that I believe is the most dangerous. Going back to 1998, when Silicon Valley Bank failed, you go back 1998, it was March of 98 when long-term capital management failed. The Fed steps in.
Right. Yep.
They were able to kick the can down the road for 2 more years. And it
Hmm.
was pure euphoria. And it still ended horrifically with the technology bubble burst. But go back to 2008, March of 2008, Bear Stearns fell. The Fed steps in.
Right.
We had this massive rally into the summer of 2008. They're telling us everything's okay. Housing is going to be fine. Don't worry. And the level of greed that I saw in 2008 managing money with clients was absolutely the worst that I had seen up until this summer. Now we're a lot
Mm.
better in the communication we have with clients, and our asset management strategy is a little bit better. So we're still participating in that somewhat. But there are times that we have to grab people by the belt and pull them back a little. There are times where we have
Yeah.
to push people forward, but there's not. I mean, you do not have to push anybody forward right now as far as the markets go, because there is a disconnect between the reality of the speed of these interest rate changes, how the
Mm.
impact. I mean, we get to the fall, there's a lot of things coming. So this is a very dangerous time, but there's pure euphoria in the markets right now.
Well, I think it's so important to have that perspective. I love the way you put that because there's always a guy who taught me a lot about trading. He called those the sucker rally. And it's almost as if Wall Street has a bunch of inventory, like a store, and they want a little going out of business sell, but it's Wall Street. So they like to sell high, not low. So they somehow get this rally going. And wouldn't you know it, Lucy with the football, Charlie Brown kicks, lands on his back. When that happens, it's surprise, a lot of retail people get pulled into those right at the end, and they do that very sophisticatedly, I think, not just by driving prices up, but if you watch the way I do, CNBC, Wall Street Journal, there's this whole marketing machine, which is just there. And AI, Paul, you got to be an AI. Like, right? Am I wrong? I mean, is that
No,
overthinking
that's
it? But
right. I
that's how
mean,
it looks to me.
the first 6 months of the year, the S&P was at 15.9%. and
Yeah.
you've got the Magnificent Seven: Apple, Amazon, Google, Tesla, Netflix. I'm missing somebody, Nvidia. Uh, are the majority of the gains. So this is what we consider a narrow rally. So the big question where we are right now is: are the rest of the stocks in the S&P 500 going to play catch up? Are we going to get that Goldilocks scenario? It's hard to imagine with the consumer under the pressure that they're under, the insurance rates going up, tax rates going up, food costs going up. That inflation is persistent. It may look great in that headline number, but the reality of what people are experiencing on a day-to-day basis is a lot different. Credit card balance. I mean, if you've got a large credit card balance out there, which a lot of Americans unfortunately do, what was it, 20.2%? Chris, was that number? I think it was over
Oh,
20%, the highest we've
well,
seen ever.
let hold on. Let me go back to the slides real quick because this is a great point. So let me know. Can you see that now?
I can, yes.
This is the one we were talking about, the consumer credit. So that's a lot of things in consumer credit. But look at credit cards and
Yes.
all other revolving plans. Look at this, nearly $1 trillion of what's called revolving credit, meaning, every month it revolves, right? It's
Yes.
not a long-term thing. So people are confused by that term, but revolving credit, I think credit cards, you got most of it. When I said there was like these massive increases, look at these huge, gigantic increases, these big, giant square wave, including that last blip that we've had there since 2021-ish. It's astonishing. What an astonishing increase. $1
Well,
trillion of
and
the highest cost debt out there. And here's interest
that's it.
rates.
Yeah.
Yeah, look at that. It was let's call it 15%, give or take, as low as 12%, there for a period of time, but
Mhm.
generally, 12 to 15. And then with the rate hikes that happened with the Fed, check this out. We go from
Mhm.
15 to 16 to 19, 20%. So now I can do this math in my head. 20% on $1 trillion is $200 billion of interest costs unless people are paying their credit cards down, but they're not. They're
No, they're
clearly
not.
building balances. So this is hundreds of billions of dollars potentially. We haven't even talked about student debt, which is not revolving, coming back online for folks. But this looks like real
October.
pain to me.
That has to be. And what's interesting is, you saw the credit card balances drop with all of the stimulus that came through with COVID. But
Mm-hmm.
look how quickly they've ramped back up. I mean, even after the 2008 collapse, you saw that huge spike, but it leveled off for several years. And now we're just back off to the races again. It's like there is no fear of the consumer that's living on that revolving credit of
Yeah,
what's going to happen in the future. Yes, that right there.
that's astonishing.
It
And it's
is.
such a straight line. Look at it. It's like there's little wiggles and jiggles in other part. This is like consumers like, oh yeah, my
Mhm.
stimmy money ran out. I like my lifestyle.
And then the pace of that move from 14.5% up here over 20%. I mean, that incomes have not adjusted quickly enough to offset that. I'm sure
No,
they're
not a
looking a little bit
chance.
better, but no way. So that's real. That's a lot of future spending that has been pulled into today. That's going to take twice as long to reduce that debt at interest rates this high. It's just
Yeah.
completely unsustainable
Well, look at these diamonds here. These are quarterly readings. So that's four. That's a year.
in one
That's
year.
1 year.
So 15 to 20, what is that percentage increase?
33% increase, right?
Yeah,
So
33% increase. It sure is, a little over. So that's a massive move. I mean, that's a lot of extra money coming out. And I don't know. I'll have to actually go back because I'm curious about this. This thought just popped in my mind. How many of those
mhm.
individuals have substantial student loans as well? So if you're carrying a tremendous amount of credit card debt, how many of those individuals have student loans? In October, that comes back online as well, which is another burden on top of the consumer.
Right. And we haven't gotten to mortgages yet, which we could throw into the mix. So just paying the banks their interest, their VIG,
Mhm.
this is now in a larger and larger share of this whole thing. And of course, now, Paul, I am a conspiracy minded guy. I'll tell you this. To me, the Federal Reserve has enough PhDs on staff that they should have known that to take a bank system where you require them to hold reserves, you require them to hold in treasuries, and then you require those tier one assets to be priced in treasuries that you've artificially driven the yield down so the price is sky high, and then you take them into an enforced, very rapid rate cycle. You don't need a PhD to know that you are going to put those banks in deep trouble.
Correct. Correct. You sure are. And furthermore, you've told those banks that we're going to keep interest rates low forever. So we're going to encourage you to go out as far along that risk curve as you can so that you can maximize your returns in there. And we're going to protect you. It'll be okay. And then all of a sudden they don't.
Right.
So, um,
I mean, if they came out and said, "Hey, our bad, we kind of, we're not omnipotent, we really screwed up our our inflation guesses, it wasn't as transitory as we said, or something. So sorry, but we understand that we're going to cause a lot of pain." But that's just on the bank side. That stuff we were just looking at with the consumer credit, with a 33% increase in revolving credit costs, right?
yes.
Everybody's faced some equivalent story like that. If you're a small business, if you were getting prime plus one, well, that's 5 points higher today than it was a year ago.
Mm-hmm. Substantially.
It's very expensive, So
And
real estate deals, we know commercial, blah, blah, blah. But the point is, the Fed knew this. I was talking about this. People talk about this because it's just completely obvious, but we are supposed to believe that, well, this is like one of those, it's like a comet to the Romans, It's an omen we can't predict.
yes. I'm trying to think what I started thinking. Was it Benjamin Franklin stated that if you hand the power of your central bank over to a Federal Reserve,
Yeah,
I'm butchering this quote, but first by inflation, then by deflation, they will rob you of all your wealth.
that's
So,
right.
if you want to lean towards looking at a bigger picture, okay, well, they slammed interest rates to zero. They encourage the incurment of debt. Okay, we're going to bail you out, bail you out, bail you out.
Mm-hmm.
Let's load the consumer, let's load the businesses, let's load the individuals with debt, and then you raise those interest rates dramatically. They have to know the consequences of that. They have to.
Yes, of course.
So,
Of course.
the concern is what happens on the other side of this. So let's take the markets on where they are. Let's step forward 6 months, and going back to what we were talking about earlier. Is this 1998 to 2000? We're in an unsustainable situation from a valuation, from a consumer standpoint. Either employment earnings have to go up dramatically to service this debt,
Mm-hmm.
or inflation's got to take off, or the markets have got to come down from a valuation standpoint to justify these businesses. But with high debt levels on the consumer, that's a tough situation.
Yeah.
So they kick the can down. We've got pain at some point in the future, no matter what. So if they kick the can down the road the year 2000, it's just going to suck more people in and do a whole lot more damage. Or is this like 2008? We've got the summer rally. The markets just don't realize, because they're too optimistic. They've been too trained that they're going to be bailed out. The consumer's a little too optimistic because they've been bailed out so many times over the past 10 years, especially, the expectation of, during COVID of, oh, all this money is going to come. I'm going to get all this relief that's going to take
Mm-hmm.
place. And we get into the fall, what happens, right? So we're in a dangerous window here where I think it was Bank of America derivatives team came out. What was the line that they said? Chase it until it breaks. So
Mm-hmm.
it's like their argument is just chase it until it breaks. The problem is you can chase it till you get wiped out when it breaks. That's the most dangerous thing for an investor.
Yeah, because what do we mean break? Normally, if you're a normal human, you have a lot of gains. You feel like you got some cushion. The market starts to turn. Couple days of down, you feel okay. Then has a day of up. Then 2 more days of down. And by the time you wake up, you find out, oops,
That's
we're
right.
down pretty far.
Yeah.
You keep thinking, oh, it'll come back because that's what it does, right? It sort of chops along, but it chops higher. So you never quite know. Like picking the top is impossible in my
It is. It
estimation.
is impossible. It's impossible. And we're due. The markets run so far so fast. We're due a correction here in the short run, and that's going to be a pretty dangerous time for investors, because there is people on the sidelines with this euphoria and the fear of missing out, of people
Mm-hmm.
to purchase that and buy in. So the question is, when we sell off, do we rally to new highs, or do we bounce a little bit and then we start setting lower lows again? It's impossible to know. That's why it's important to have your decision points and lines in the sand and say, hey, I don't know. I don't know how this is going to pan out, but I'm looking at my long-term picture, and these are the greatest risks to my success. And then you manage that money accordingly. So
Yeah. So let me ask you one more question then, before we turn to the CPI and then another piece. So we've seen this. We have a credit-driven society. Took the Bank of England till I think 2016 before they figured that out themselves, and that's where money's created. But we've only had one other period of time, Paul, in my entire data series where this went backwards, and that was 2008 to 9, right? And that of course created a lot of damage. So I'm watching the bank credit, and Dave Fairtex at our site writes about this all the time because it's really important. On a year-over-year basis, this looks terrible, but um, it's it's dangerously close to dipping into negative territory, which that's crazy times for our debt-based money system. The way I interpret that is this is all commercial banks. This is all credit. This includes everything. This is the whole thing, right? Everything you could loan money for at a commercial level. This shows up here. Well, if you have less borrowing, you're going to have less GDP. That's just how the math works out. It's a thing. Professor Steve Keen proved that elegantly. It's just math.
correct.
And so this looks to me very contractionary, but if it slips below zero, it actually gets very deflationy. It gets
Yes.
gets pretty bad. So what do you see? How do you interpret this one?
Well, I interpret that the same way you do. My concern is that's deflationary across the board. I mean, bank credit and all commercial banks, that's directly tied to commercial real estate, some of your real estate construction loans. If that goes negative, then that's a tremendous amount of fuel behind real estate and even businesses in general that turns deflationary. So,
Mm-hmm.
and there's few believe that real estate can have a crisis at this point out there, at least in those that I'm talking to.
Mm-hmm.
But that's deflationary. At some point, that's deflationary, especially with our system having to expand on credit because that's the fuel that keeps asset prices inflated.
Mm-hmm.
That's a concerning
Yep.
chart.
Well, yeah, I think so, but um, what do I know? No, I've been studying this long enough. That it's very concerning chart right there. So, um, well, we had the CPI Consumer Price Index came out today. I called it Gooberment lies, not government, because it's just I gotta give them no props for what they do because I write about this a lot and it's in the crash course. This idea that the BLS, um, Bureau of Lying Statistics, right, to be polite about it, they have all these things that they do: hedonic, substitution, weighting, every one of which is designed to either minimize something or take it out of the basket of goods, or in other ways, just make inflation look better than it is actually.
Yes.
And they say now that inflation rose 3% year over year, but that again, it's not true based on my auto insurance, my home insurance, my health insurance. It's not true based on my trip to the grocery store, airline pricing, lots of things, right? It's
Oh,
not
yeah.
my experience, right?
No.
Um, but even still, it came in slightly less than expected at 3% year over year today. And so what did that turn into? Let me start sharing this again. It turned into this. This is a snapshot taken in the futures market this morning, right at the, just about 10:30 this morning. But before the markets open there at 8:30, when they release these things, you see the Dow Jones. Look at that. Heavy industrials jumped. And I guess the story is that some AI program will write for CNBC is investors were cheered by the idea that
Yeah.
perhaps the Fed can pause sooner. Okay. That's okay. So, but also all the large caps jumped a huge amount.
Mm-hmm.
And oh, well, technology shares. Yeah, sure. Also Japanese shares for some mysterious reason. Oh, in German shares. And Germany's sucking wind right now. Don't even get me started, right?
They
Euro
really
stock.
are.
So how do we interpret this? How is it we're supposed to believe that Japanese stocks got all excited? By the way, their markets closed at the time when this happens, right?
Yes.
Middle of the night, their markets are closed, but their futures market is suddenly super excited because inflation in the US came in at 3% with these fraudulent statistics instead of the expected 3.1%. Um, how do you make sense of that?
I don't know. It's so hard to make sense of it from a fundamental standpoint. I mean, yes, we should all be relieved that supposedly the inflation numbers have come down some, but the reality is, what's causing the markets to move this much? Is it Is it a, oh, great, we're going to have a hard, interest, we're going to have deflation in the future and the Fed's going to slam rates to zero and we're going to try to front run that? Is that what we've resorted to economically now, that we're just continually pushing that edge, and the realization that most businesses can't survive if they have to reset at higher rates? Somewhere, I think it was Mike Green, made the comment, said at today's interest rates, 80% of the Russell 2000 is unprofitable if they had to reset. Now they're locked in at lower rates, correct?
Mm-hmm.
That's an unbelievably terrifying number, and I may be wrong on that, but even if it's above 50%, that's terrifying. So maybe the market's just, hey, they're going to say that. I don't understand why the market would run that much unless it's just the absolute fear of missing out that's causing these triggers and computer programs to try to front run what they think the investor is going to do. Doesn't make sense. I can't make sense of it.
Yeah. Yeah. I honestly think that it's not a discounting machine anymore. It's just it's a liquidity gauge with a hefty dose of speculative front running welded on there,
I
you know.
agree. I agree.
And I'll guarantee you that there's a lot of, I keep looking over here because that's where the slides are on my screen, but I guarantee you, Paul, there's going to be a lot of 28, 30-year-old coders working on these algorithmic programs in private equity and hedge funds who have never seen a bear market, not a real one,
Right. No, and unless you've seen a real bear market, you don't understand. And that's, on our investment committee, we have somebody that's never managed through a bear market, and it's actually one of a great perspective to have, because there's no fear of this market right now. It's like, hey, we're off to the races. We've got the Goldilocks scenario, and the good thing is you're covered by a lot more experience on the investment committee, but it is a good perspective to have, and that's what a lot of investors are out there today, that all they have seen is the Fed bail them out
Yep.
and slam rates to zero. So we're in a pure speculation environment based on everything I can see right now, because yes, the data's held up better than what we thought that it would at this point. And maybe that's just because there's so much money sloshing around the system that's still left over from the COVID money printing spigots. And you've got the Fiscal Responsibility Act that's just juicing all kinds of money into the economy. I mean, Fiscal Responsibility Act. We could probably spend 30 minutes talking about how ridiculous that name was.
Yeah. No, it's obviously a misnomer, oppositely named from its actual intent and outcome. But yeah, so well, let me take you through. I got this one last slide here I want to look at, because this one is just really astonishing to me. I just came across it today. I'm trying to digest it, but the way I understand this, they call this companies hoarding labor. And we would see that by firms increasing their employment percentage. So that's the percent still planning to hire. That's in purple. It's way up here. And if you're still planning to hire, that means that's called labor hoarding, because, if you're planning to not hire, or, they're still holding on, even though profits, earnings outlook, percent higher or lower. This is on the right-hand scale down here. So I guess this would be about 20% of firms are still looking to increase employment, but a percent higher or lower, minus 20 some percent on earnings is the expectation. But the point here, Paul, is that this starts back in 1990. We got a lot of decades of experience, and you can see this is a super tightly correlated series. Super tight. Makes sense, right? Companies, when they have profits, don't have profits, they tend to shed. This is an enormous gap right here. And so the way I interpret that, either profits are going to tank because you're paying for a lot of people and your profits aren't good, or a lot of people are going to get fired. I don't know. Looks pretty clear to me.
Yeah, that does look pretty clear. I'm just curious, thinking out loud, having not seen that. Why would that divergence take place, and what are companies thinking when your profit expectation is so negative, but you're looking to increase employment that highly? So everywhere I go, businesses are talking about how hard it is to find good help. People just don't have the work ethic that they used to. So, I don't know if that has something to do with, hey, we're trying to hold, or we're looking to hire good people, and maybe we're not pulling the trigger. And if we can get good people in here, we're going to purge out all the dead weight. But I just don't see how corporate America is going to continue to to not fire a lot of people if their expectation for revenue and earnings is that negative.
Well, so to the extent they're concerned about like finding good people, we have another statistic I didn't put on top of this, but now that you're talking about it, it makes me think of it, which is Ed Dowd keeps pointing to the fact that we have 3 million more people on the disability rolls now than we did in 2021. And something
Yeah,
happened there that which this is behind our paywall, so this is all fine for me to say, but it's clear that there's a lot of injured people out there, probably from the vaccine, from long COVID, from something, who knows what it was, but there's a lot of people on the disability rolls. And many of them are what we would call prime working age people with experience and everything. So
yes.
maybe companies are just feeling a little, we better hang on to the people we got because we can't, maybe that's part of this dynamic, but that's a huge thing. 3 million people off on disability.
That's a huge thing.
Extra.
I saw that because I like the work that he puts out as well. And, the question that I had is a combination of injuries and just a government that's willing to approve people they otherwise wouldn't approve that are applying just to get money into the system to try to kick this can down the road.
Yeah.
I'm very distrustful of that. It just seems something doesn't add up there. So I wish we could figure out what those statistics actually are caused by.
Yeah. Well, so given your experience, you've been down, not your first rodeo here, looking at all this data, how do you begin to approach portfolio decisions, given that?
Well, that's it's challenging in this environment. So from our standpoint, it's pretty simple. You just got to be cautious in this environment.
Mm-hmm.
We're somewhat invested, straddle the fence. From an asset management standpoint, not getting into all the details, but we pushed a few cards on the table after being defensive for most of 2022 back in November, December. The market had been down to the point that a rally was expected.
Mm-hmm.
My expectation is a counter trend rally. I thought that might last until the April kind of time frame, and then we would start to peter out because I was expecting the economic numbers to look a little bit worse. Here we are midsummer, and compared to past bear market rallies, this has been longer than most. It's not uncommon to see a 20% rally. I think we had 8 of them in 2000 during the 1929 sell-off. I can't remember how many 2000, 2002 without cheating and looking at the statistics.
Well, this one had an extra 400 billion stimmy thrown in October of 22 by the Fed. Still working that off.
That's correct. So Silicon Bank, that stimulus came in. So we're working that out. So it's just extra money sloshing around the system, push this higher. So really where you are, if you're an investor who's in, you have to have your decision points if you want to risk manage, if you're concerned about prices going lower, which I am. So the conversations I have with somebody that comes in, they're already fully invested, is okay, look, here are the exit points, right? We would hope that this market's going to kind of gradually roll over and we don't get a 1987 kind of Wile E. Coyote event, which is not outside the realm of possibility because of how detached we are from what's taking place with interest rates. So we want to keep those real close so you don't take a chance in getting caught up in that. If you're an investor who's on the sidelines and you've been on the sidelines for a while, right now is a very dangerous environment because you can't chase this. This is a pure speculative move. So you have to be patient. And so, if I had somebody come in recently that's been 100% cash and they're like, hey, I want to take a wise approach to this with some risk management that's adaptive, then you just got to wait this out because we're really not going to know where we are until we get that September, October timeframe. And hey, worst case scenario, you miss a little bit of opportunity. If they kick this can down the road another 2 years, there's a chance to get a little bit lower risk return. But right now, this is the environment where you want to pull some cards off the table, raise some cash, and get prepared for the uncertain period of time coming in the fall. Because Chris, I've been arguing with on the investment committee, I do not believe that the market's pricing 6 months out. I think it's following the money flows and it's the narrative game and it's the fear of missing out that's driving this right now. And that's not unusual to what we've seen in the past. The question is, when is it over? Do we go to new highs before it goes lower? That's highly possible. The momentum that's here, I think we've got enough to carry through for another 3 or 4 months or so. But
Feels right.
reputable individuals that are very careful to say the market is close to a top have come out and said, "Hey, we're close." And I think Fred Hickey, I've always followed his newsletter
Hmm.
writing, and his most recent newsletter said, if I can remember, "Up it goes before it blows." Three. So
Yeah, there it
he
is.
wrote
The
one
sucker
in
rally.
he wrote
Yeah.
one in December of '99. He wrote one in summer of 2007, and he's like, "I was a little early on that," but the point is, you've got that last burst of momentum with the absolute disregard to what's taking place under the surface. So for an investor, the interesting thing and the challenging thing is there are a lot of opportunities around the world. There are areas that have been overlooked by this rally. There are areas that will benefit from from the market turning. So you just have to be flexible, and you have to be patient more than anything, and turn the TV off. Get it, have a
Yeah.
strategy and a plan. Then when you start feeling that fear of missing out and going, "Oh no, I've got to go buy." I had somebody call in yesterday that was in a near panic to buy some uh big some cryptos because they read a report that the whole currency is changing like tomorrow. But just calm down, take a deep breath, take a long-term plan, and put some critical thought into asset management. That's what we help people do.
Right.
So
Yeah. Well, I am so thrilled to be working with you and to be, helping to promote your awesome service. And by the way, the early feedback we've gotten from people you've worked with who we've sent your way has just been nothing short of stellar. I mean, as expected. So,
thank you,
just
Chris.
fabulous. The way you treat people. And of course, if somebody wants to talk to somebody like you who can actually talk about Ed Dowd's work or Fred Hickey's or all that,
Yeah,
yeah, then you've come to the right spot. So, for anybody interested in following up, as I close out, I'll just tell you very quickly, this is the name of our registered investment advisory that I am associated with, stood it up, Peak Financial Investing. You find it at that link right there, peakfinancialinvesting.com. And if you went there, you would find a front page and there'd be some videos. You'd see Paul there. And then if you wanted to go further, this would be the whole process here on our end. You would fill out this form. The red dots say the things you have to give us. And you just say a few things, and then an email gets kicked out, and somebody on Paul's staff will get back to you and open a conversation. So that's how the process works right now. Very simple, very easy, no obligation.
yeah.
But I'm really thrilled with yeah, it's been really good feedback, Paul. So
Thanks. I've
wanted to say that.
enjoyed it. I mean, wonderful people. I had a conversation actually right before we got on the phone, and was able to share a couple of ideas to really solve some problems for an individual. So it's been enjoyable. It's nice to talk to people who understand the reality of what's taking place in our economy, and looking for someone who's been living in that world and learning to navigate that world in a prudent manner, so we can stay invested when we have the opportunity, but we have quick exits in case things turn, and an adaptation to move into the areas that traditional investing, the Wall Street doesn't want you to go into because it's not as profitable for them.
Of course, of course. Well, Paul of Kuiker Wealth Management, Paul, thank you so much for your time today. This is a great conversation. I'm really looking forward to doing this on a routine basis. You really helped me think through some things there. So thanks for that. Thanks for your time.
Thank you,
And
Chris. It's my honor.
same, likewise. All right. Well, thanks everyone. We'll see you next time. Hope you enjoyed this. Leave your comments down below. And of course, if you need to get a hold of Paul, just let me know and we can get that connected. All right. With that, thanks very much and see you next time.
Have a
Bye.
good day.